Welcome to another session, guys. This session is also going to be a continuation of the application of the accounting equation. Remember, we said that the accounting equation is a tool that we use to analyze and record transactions on our books. Accounting equation is a tool that we use to analyze and record transactions on our books. So this video is going to be a continuation of the application of the concepts of the accounting equation. If you want to know the background and the logic of the accounting equation, please feel free to refer to our previous videos so that you get a thorough explanation of what is an accounting equation, why do we use the accounting equation, and what's really the logic behind the accounting equation. All that information is on the previous recordings that we have here on our page. I'll also try to provide their links on the description below. So let's start with this question. So this question is from a question paper from last year, EACC1614. So it's a question paper from the previous year, 2022, and this was question 2, which was 20 marks for 30 minutes. So the required, according to the question, is that we should record the above transactions in the accounting equation using the attached sheet, which is this sheet below. They also gave us an example of how to go about recording these transactions. Here we are also specifically told that our answers are to comply with the International Financial Reporting Standards. Remember, we spoke about IFRS on our previous videos as well. And then we are also given instructions that we should round amounts to the nearest rand and show all calculations clearly. Assume that all items and amounts are material except where information clearly indicates otherwise. So number two, let's start with number 2. We are told that BFH, okay, let's read the background information first before we jump into number 2. So we are told here that the following transactions of Besfin Holdings BFH for February 2022. Okay, the following are the transactions of BFH for February 2022. BFH offers different financial services to its clients, both cash and credit. So this is the background about the business. We are told that it's a financial services company which offers both cash and credit transactions, or both cash and credit services to their clients. So that was just the background, but the juice of everything is on the transactions. Remember, our goal is to take the data in the form of daily transactions, take the data and input the data into our accounting process, where the first book of entry, as we have spoken, is the general journal. For us to do that, we need the accounting equation to help us to analyze and record transactions. So when we analyze and record them, it means that we are classifying these transactions according to the accounts. Because when we classify these transactions according to the accounts, we will be able to represent them in the financial statements. So that's what we are trying to do. We are doing the accounting equation. We are recording transactions on the accounting equation so that we learn how to analyze and record transactions. Once you understand how to analyze and record transactions, you will be able to record transactions on the general journal. You will be able to record transactions on the general ledger, for an example. You will be able to record transactions on the T accounts. So this topic is very important because it's going to be the backbone for everything that you are going to do in accounting. So it's very important that you also understand what we are trying to do here. So here they say BFH this transaction on the 1st of February. So they say BFH started with a capital contribution. They are speaking about capital. So what did we say about capital? We said that capital results in an increase in equity. And we said that equity increase on the credit side. And, remember, the accounting equation states that A is equals to E plus L. And then I told you that you only need to know that assets increase on the debit side and then they decrease on the credit side. And then any other element which is on the other side of the account of the equal sign is going to have an opposite reaction to that of our assets. So what does that mean? It means that if assets increase on the credit side, then equity and liabilities, they are going to increase on the credit side. If assets decrease on the debit side, then equity and liabilities, they decrease on the debit side. So this information is the one that we'll use to analyze transactions. So we are told about capital contribution, and we agreed that capital is a form of equity that happens as a result of the owner's involvement into the business. How is the owner involved in the business? He contributed capital. Capital results in an increase in the equity of the business, and equity increases on the credit side. It's here. So that means that equity is going to increase on your credit side, and then they are telling us that the capital contribution received from the owner is 2,000. The amount was deposited into the bank account. So the owner deposited funds into the business's bank account. We have already established that the capital is going to increase, but if the owner invests funds into the business, that means that the amount in the bank as well is going to increase. And we just said that assets increase on the debit side. So what's going to happen is that bank is also, because it's an asset, it means that it's going to increase, and assets increase on the debit side. So this is how we are going to record. So it means that we are therefore going to debit what? We are going to debit assets, which is the bank, and then we are going to credit. Capital. It's here. So let's go and record. So 1, then account debited is bank. Our assets are going up. Is bank, which is an asset. And then account credited is capital, which is how much? Which is 200,000. So you'll add here 200,000, and then under equity as well, you will add 200,000. Then liabilities are not affected. Then the next one. Okay, let's do the next one. Number 2. We rendered services to Mrs. Sibanda valued at 40,000 on credit. So we offered our services to a client, but this client, we offered these services to him to her on credit. And so that means that we made a sale, or we rendered services, whichever wording you choose, it's fine. So that means that here you have your what? You have your services rendered, and your services rendered results in what? Is income. Okay, so when you render services, you are expecting income, so you are expecting to be paid. And this person, because we rendered services to her on credit, it means that they will pay us later. And so this means that since they got our services on credit, this is our data. At this level, we call a data a receivable. We are expecting Mrs. Sibanda to pay us back at some point. So a receivable is treated as an asset because we are expecting to receive money from this person. So it means that our receivables are going to go up because the number of people who are owing us increase. It means that our assets increase, and assets increase on the debit side. And then services rendered. Services rendered is an income. So this is money that you are expecting to receive as a result of business operations. Remember yesterday when I was explaining the accounting equation, I said that there's equity as a result of business operations and equity as a result of the owner's involvement in the business. The equity as a result of business operations includes income and expenses. So when you render a service, you are expecting to get income, or you get income. So income results in an increase in what? In an increase in equity. So income will result in an increase in equity, and the increase in equity is always credited. So you come back here, you record. So that means that you are going to debit the asset receivable. You'll debit this asset, and then you credit service rendered. And how much? It's 4,000. 4,000. So that means that our assets are going to increase, and then our equity is also going to increase. Nothing affects liabilities. On to the next one. Okay, next, purchased. To purchase is to buy. So what are we buying? We are buying an asset. We are buying an asset called equipment. So this is the account that we need to work with. How are we buying this asset? We are buying this asset on credit. So as you've seen by now, the pattern that you'll find from transactions and how to get accounts from transactions, you will be told what happened. We bought something. The transaction will also tell you how the thing was bought. Was bought on credit or cash. If it was bought on credit, it means that payables are going to be affected because you're increasing your score load. If it was bought cash, it means that the bank is going to be affected. And so what I'm trying to say is that if you want to get information from transactions, the transactions are going to tell you two things. They will tell you what was bought, what was sold. That's where you get your first account. And then they will also tell you how the transaction took place. Was it cash or credit? And then there's your second account as well. If I were to give you a tip on how to derive accounts from transactions. And so here we purchased equipment, and then we said that equipment, then this equipment that was purchased is an asset. So if you buy an asset, it means that you are increasing the value of your assets now, and assets increase on the debit side. This asset was bought, however, on credit. It means that we are increasing our liabilities. So we said that liabilities increase on the credit side. Remember, equity and liabilities, they increase on the opposite sides of our assets. If our assets increase on the debit side, equity and liabilities zonas, they increase on the credit side. So what does this mean? It means that our liabilities in the form of payables are going to increase. They will increase on the credit side. Okay, so what we are going to do is that we'll debit equipment, which is an asset. So we are saying we bought equipment, and then this equipment was bought on credit. So we are going to credit a payable. How much? How much is this equipment that we bought? Is 30 blocks. So it's 30,000 plus. This equipment was bought on credit. So here is increase of liabilities by 30,000. Nothing affects equity. Next transaction. Next transaction it's telling us about the owner as well. Remember yesterday or on the previous video, I said that the owner can be involved in the business in two ways: when they invest resources or when they withdraw resources. When they invest resources, we call it capital. When they withdraw resources, we call it drawings. And so here, how are you going to record this transaction here? So you are told specifically that what happened, the owner withdrew funds. It means that drawings are triggered because it's taking resources away from the business. And then they tell you as well that these funds were withdrawn for personal entertainment. Who knows? Who knows? We bekafuna ukenzani ngale mali, yabo? Kwazi yena. So how are you going to record this? You are going to have your drawings, remember? And then what did he withdraw? He withdrew cash. Remember? So that means that we are going to have these drawings now. So we are going to have drawings, which is equity. So drawings result in a decrease in equity. And then he withdrew cash, and then you are going to have your bank. He's taking away cash, he's taking away resources from the business. So that means that bank, which is an asset, is going to decrease. Where do assets decrease? Assets decrease on the credit side. How do drawings affect equity? Remember, we said that drawings result in a decrease in equity. So equity decreases on the debit side. So that means that you debit drawings and then you credit bank. So drawings are debited. In fact, drawings are always debited, and then you credit bank. But I don't want you to cram. Remember, I'm teaching you to be scholars of accounting. I don't teach people to cram. I want you to understand why do you even debit the drawings. I don't want you to cram it. You must know it and say it with confidence. So he withdrew 3,000, and then so that means that our drawings are going to decrease equity by 3,000, and then they will also decrease our bank by 3,000. Nothing affects liabilities here. And then this is number 1. This is 2, 3, 2, 3, and then 5. Then the next one. On the next transaction, we are told that we received 2,000 from a receivable, Mrs. Sibanda. Remember, initially we had sold to Mrs. Sibanda on the 2nd of February. We had sold to Mrs. Sibanda goods, or we had rendered services to Mrs. Sibanda that was worth 4,000, and now Mrs. Sibanda is paying us. So when she's paying, what's going to happen? So she's paying, that means automatically we are getting money. So bank is affected. But what is she paying? She's paying to reduce her debt that is already there. This is her debt. She has a debt of 4,000, so she's paying 2,000. So she's reducing our receivables. So this is what's going to happen. So that means that the receivables, so you are going to have your receivables here, which is an asset. She's paying this receivable, so she's reducing the amount of these receivables. So it means that this will result in a decrease in receivables, which is a decrease in assets. But she's paying cash. Okay. So what does that mean? It means that the amount in the bank is an asset. So this amount is going to increase. I hope it makes sense, guys. So that means that if bank is an asset, then and bank is increasing, then we record on the debit side because assets increase on the debit side. So how are we going to record? So you are going to say, okay, I'm going to debit my bank because my assets are increasing. So I'm going to debit bank because my assets are increasing, and then I'm going to credit again receivables because my receivable asset is decreasing. So this is an asset as well. So what will you do here? You'll say plus 2000, then minus 2000. Then you get 0 here and 0 here. Number 9. Okay, so the next one, received cash of 7,500 for services rendered. So we rendered services again, but this time we did not render services on credit. We rendered these services and received payment cash. Already cash is going to affect what? It's going to affect the bank asset. So it means that it's going to go up. Bank is going to go up. And if bank is an asset, that means that the bank is going to be debited. And then here, we received 7,000 for services rendered. So services rendered, which is income, results in a what? Results in an increase in equity. And an increase in equity is credited. Hope this makes sense. If you'd like to understand why am I crediting and why am I debiting, please just refer to the previous videos and then come back to this one. You'll see everything will just be clear. I just don't want to repeat the same things. It's very important that we just apply the principles in this video. So here we are going to debit bank and credit services rendered. So bank, which is an asset, and then service rendered, which is income, is going to increase as well. So bank will say plus how much? 7,500. 7,500 here plus 7,500 because equity is increasing by 7,500 as a result of the income. Next, pay amount due to a payable. A payable, we are paying a payable. We are paying a skoloto, so we are reducing a liability, which is Mr. Ndo 9,000. So we are reducing a liability. Remember, we said that assets increase on the debit side, they decrease on the credit side. And then equity and liabilities, they increase on the opposite side. So they increase on the credit side. So equity increase on the credit side, the liabilities increase on the credit side. And then they also decrease on the opposite side. So if assets decrease on the credit side, then equity and liabilities, they are going to decrease on the debit side. So we are paying a liability, so we are reducing a liability. That means that we are reducing our skoloto. So that means that we will have liabilities here in the form of payables. In the form of payables. So this is the account. Our liabilities are going to decrease because we are paying them. And so they will decrease on the debit side. How are we paying these liabilities? We are paying these liabilities cash. So that means that bank is going to be affected. So bank is an asset, remember. So when we pay, money is going out of the bank. So that means that we are reducing our bank. So it means that our assets are going down. And so that means you credit the asset bank. So here, payables, which is a liability, we are decreasing it, hence it's debited. And then bank, which is an asset that we use to pay these liabilities, is going to decrease. So here you will reduce your payables. So you'll reduce your payables by how much? By 9,000. By 9,000. And then you'll reduce your bank by 9,000. and then nothing affects equity there. Next, we purchase stationery from office store 5,000. Okay, this is interesting. So we purchased stationery. So stationery is considered as an expense, so it's a cost to the business. So we purchase stationery, which is an expense. So an expense is a cost to the business, so it results in a decrease in equity. So you'll say, okay, stationery, and then stationery is an expense. So expenses result in a decrease in equity. So that means that they will be debited. Pay 3,000. So remember, I told you that the transaction is going to tell you two things: what happened and how the transaction was paid for, or how we received the money when we are receiving money. So in this instance, we are paying for stationery. So we have already been told what was bought, so we need to be told now, how was it paid? Was it paid cash or credit, or even both? So here they tell us that you pay 3,000 immediately, pay 15, which is bank, and then the balance is payable in 30 days. So you will pay cash some of the debt, and then the rest you'll pay is going to be a liability. So that means that bank is going to be affected, and when you pay cash, your bank is going to go down since it's an asset. So it means you will credit bank, and then the rest of the amount, which is 2,000, is going to be a payable. So it's going to be a scoloto, a liability, and this will increase your liabilities on the credit side, because we said liabilities increase on the credit side. Again, so how are you going to record this? So you'll say, okay, stationery, then this stationery was paid through bank, and then the rest will be a liability, which is a payable. So you'll say, okay, 5,000, an expense, 5,000, and then this 5,000 is going to be settled through 3,000 from bank. Is 3,000 from bank, and then the rest is going to come from this, which will increase our payables. Okay, let me see again. It's going to be 5,000. Yeah, it's fine. Okay. The last transaction now. The last transaction. Okay. So here we are told that we are paying bank charges, and then on the bank statement they amounted to 249. So do this one on your own. I'm just giving you maybe 2 minutes, just to do this one on your own. Just take out a piece of pen and paper and try to do it on your own. Okay, I hope you are done. So remember, we did this one yesterday. Bank is a charge, which is a cost. So bank charges is an expense. So that means that expenses result in a decrease in equity, because it's a cost to the business. So they reduce the wealth of the business, which is equity. And then we paid these bank charges cash. It means that bank is going to be affected. So bank, which is an asset, is going to go down. So when this asset goes down, you credit it, and then bank charges, because it's an expense and they result in a decrease in equity, we said equity decrease on the debit side. Okay? So that means that you come here, you say bank charges, and then you will have your bank as well. We did this transaction on the previous video. How much? 249. So our assets are going to go down by 249, and then our expenses are going to reduce equity as well by 249. Then here is 0. Let me just put the numbers here: 12, 22, 28. 12, 22, 28. So this is the end of this video, guys. Just try to make sure that you understand what we did here, and if you have any questions, you are free to send them on the comment section, or you can ask on our WhatsApp group as well. We are going to be able to reply to your questions gladly. So remember, this is a past paper question. It's from last year's question paper. It's from last year's semester 1, test 1 question paper. So that means that if you got this thing correct, you'd have 20 marks out of this question paper, which was out of 60. So, which is something. So if you would like to order the study guide as well, please send us a WhatsApp. We will reply to you. And then if you'd like to get a background and also an understanding of the accounting equation and why we do the things that we are doing here, there are 3 videos that you can go back to and watch where I explain the accounting equation in detail. So yeah, thank you very much, guys. I'll see you next time.